Welcome to the overview of Chapter 16 on inflation, disinflation, and deflation. That's Chapter 16 in the online textbook, Chapter 33 in the book. Thanks for joining me. I hope you find this helpful. What are we going to look at in this chapter? We're going to look at inflation, this idea of an inflation tax. We'll look at the Phillips curve and what impact unemployment has on inflation. Is there a trade-off between them in the short run? Is there a trade-off in the long run? What policies can be taken in order to limit inflation and to keep it from rising? And if we have little inflation, what is the concern about deflation? And what is really the optimal point at which we have an inflationary expectation in the market, and how does that impact the market as a whole? And then what is this zero bound business? We're going to take a look at that as well in terms of how we close out the chapter, looking at this idea of disinflation and the roles that this plays. So thank you for joining me. As a reminder, we have explainers on the crowding out effect, which is what I'm going to cover first. This is the explainers for the crowding out effect. We also have explainers on inflation. And then if you need a little help on the differences between inflation, deflation, and disinflation, there's a very short Federal Reserve video from the Federal Reserve Bank of Philadelphia that addresses this and really kind of outlines those differences, and a short explainer on that. But first we're going to talk about loanable funds and this idea of the crowding out effect that we've kind of alluded to in previous chapters, but we're going to delve a little deeper here. So the loanable funds market is the idea that is there money out there in the marketplace that people can borrow or that banks can loan out, and what is this market for loanable funds? Interest rates are determined based on the amount of loanable funds that are out there, and obviously the demand, the supply and demand of those funds, what's supplied, but also what's demanded of those funds. So we see that the interest rate is based on the equilibrium between supply and demand. So demand is downward sloping, as we would expect a downward sloping demand curve to be. If the interest rate is higher, the quantity of loanable funds that is demanded would be smaller. And if the interest rate is lower, the quantity demanded of loanable funds would be greater. The idea, just the same as a typical downward sloping demand curve. As the price is higher, the quantity demanded would be smaller, and as the price is lower, the quantity demanded will increase. So that's typical of what we see in the demand for loanable funds. The supply of loanable funds is the idea that as the prices rise, the supply of those funds also rise because businesses want to make more money. So as the interest rate goes up, the supply of loanable funds will go up because people will be more willing to put their money, and banks will be more willing to loan the money to individuals at a higher rate. They're going to make more money as a result of this. This leads to the loanable funds market in key graph 32. The upward sloping supply of loanable funds, the downward sloping demand of loanable funds meeting at equilibrium. There is a real interest rate, again, inflation not in this picture because it is real, so inflation taken out. The real interest rate based on those supply and demand of loanable funds will meet at the quantity of loanable funds that we see there at point Q, or the line Q based on the equilibrium at point E. So this is the loanable funds market, supply and demand, and is typical of what we've seen in many graphs, such as key graph 5, the idea of the supply and demand of the market. So no difference there. The real difference is going to be what happens and what's taking place here when it comes to loanable funds. We see when the government borrows money, and a good example of this is stimulus. When the government approved the stimulus bill that we just saw, the $1.9 trillion stimulus package, the government's borrowing money in order to pay for that. And they're going to need to borrow that money from somewhere. So they're going to conduct a sale, if you will. They're going to sell bonds in order to borrow this money that they'll eventually pay back to people. And they're going to borrow money in order to do this. Well, what's going to happen here is that the demand for loanable funds is going to increase. It's going to shift rightward. The supply is going to move along the curve to a higher interest rate because of the borrowing. Everybody's paying more in interest rates for this. And so the quantity of loanable funds is greater, but the interest rate's also greater. And so what this does is it creates a larger quantity of loanable funds, but at a higher rate. And when it comes to a higher rate, businesses don't want to pay a higher rate. So essentially, this is crowding out the opportunity for businesses to borrow money, in addition to scarce resources. So when we see deficit spending, the idea like the stimulus package we saw, we can see here the demand for loanable funds is increasing, and the demand for loanable funds increasing, supply moving along the curve to a higher rate. So demand is improving, the real interest rate is rising, and as a result of this, we're seeing government spending a lot of money buying resources that business and private investment would normally be buying, which means they're going to be buying less. So because the government is spending the money in these places, again, scarcity, there's only so many resources out there, the private investment is going to be smaller because they're not going to be making those investments many times because of that interest rate increase, because of the interest rate that is going up there. So we see a significant change in that capacity. Now, if the government increases that deficit spending, as I mentioned, the total number of loans is going to increase, but that's because the public is selling bonds, is basically borrowing money to pay for this stimulus. So it also means that private borrowing, in which businesses take out loans, is going to decrease. They're not going to be putting in a new facility or buying new capital equipment. Why? Because the interest rates are higher. So it's going to essentially diminish the power of business to be able to take on loans and buy new equipment and capital to invest in their businesses. So this is essentially crowding out businesses from being able to participate in the economy like they would want to in that capacity. So in the long run, is the higher impact what is the long-run impact of higher real interest rates? Well, it's going to be less economic growth, because if business is spending less, that means less capital, less investment, less innovation, less entrepreneurial spirit, fewer new technologies, and fewer ways to grow real GDP. The government's spending money, that's going to encourage growth, but in a time when you're in an expansionary period, if you're spending too much money in this space, you're discouraging business from spending money because of those higher rates. So it is going to lead to less investment and ultimately less real GDP growth than we would see otherwise, because the government is crowding out private investment in this space. And this leads to key graph 33, which is the loanable funds market, showing this crowding out effect that is occurring. Now, what you see on here isn't the private investment, because businesses aren't investing any more in this space. Actually, with rising interest rates, they'd be investing less. But because government is kind of bridging that gap and making up the difference, it is helping them. It is helping to buoy the economy, if you will. But it's not showing, as we saw in the last graph, that business is going to be affected because they're not expanding their technology and their innovation like they were before. And that's having an impact here. Now, increasing private savings. We're going to see, as those interest rates rise, more people are going to want to participate in the economy in that respect. But when we had the pandemic back last year, when COVID initially hit and everybody went home and basically stayed at home in self-isolation for, a year, we had a number of people that stopped spending. They weren't going out to restaurants, they weren't going to movies, they weren't going to hotels, they weren't going on vacations, and this led to an increase in private savings. Now, this is a supply of loanable funds that is increasing because more people are not spending the money, consuming, they're saving, and saving shifts the supply of loanable funds. So when you have a significant change like that, and the supply curve shifts here, then that leads us to a lower interest rate in that capacity. And that also discourages real GDP growth, because the idea is, while we have a greater quantity of loanable funds, we have fewer people going out and spending money and consuming in the economy that would be growing real GDP at that point. So that is difficult because it's a scary situation on the savings front. You have more loanable funds at a lower rate, which is going to encourage investment by businesses, But you also have a reason why people aren't going out and spending money, and that's going to discourage spending by businesses. So they're probably a little more hesitant to take out that loan if they know that consumption, sales aren't where they used to be. And that leads us to key graph 34, this idea that the increase in the supply of loanable funds reduces the real interest rate but does improve the quantity of loanable funds. Don't equate that, though, with improvement of real GDP, because it's going to depend on what else is going on in the economy. Why are the supply of loanable funds increasing? If it's because people are saving, then that's wonderful, as long as they're continuing to go out and spend. But if they're saving at the result of not being able to go out and spend money, that is having a negative impact, and that could impact real GDP, which isn't necessarily a good thing in this capacity. So you got to keep in mind what is going on in the context of the scenario, because if you are seeing an increase in loanable funds, but real GDP, the economy is actually in recessionary type qualities, that may not be necessarily a good thing to see an increase in loanable funds. It's not going to encourage business to go out and spend money if we're seeing a recession looming on the horizon, even though there are lower interest rates. They're going to be looking at the forecast as to where the economy is going. They're going to make that decision not just based on interest rates alone. They're going to look at what the economy is doing and where it's headed. All right, so let's go to this idea of inflation then. So that's kind of the crowding out effect that we have seen. The focus now we're going to talk about is in inflation, hyperinflation, this idea of disinflation and deflation. So let's first talk about inflation. It has gone all over the map over the course of history in terms of inflationary tendencies. Brazil is a prime extreme example of this 3,000% inflation rate. I mean, imagine walking into a restaurant and looking at the prices on the menu, and by the time you leave, the price has doubled, tripled, quadrupled, if not more, and you are basically stuck paying that because of the disastrous inflation rates that are going on at the time. Now, this leads to political upheaval, as you can imagine, and people asking for new leadership and new leaders in the country to stabilize the currency. This is why the International Monetary Fund is so important. The International Monetary Fund is really about regulating currencies and keeping them steady. And for this reason, they don't want countries having new leadership and having to overthrow the government in order to bring prices down. That nobody's going to win in that scenario. So how can we regulate currencies in a way that keeps them steady, keeps them balanced with the other currencies that are out there, and still promotes trade and growth in those economies? That really is the purpose of the IMF. That really is what they're trying to do, is keep inflation at bay through stabilizing currencies and currencies across the board, which is very, like I said, very international in scope. The inflation rate does tend to mimic the money supply in terms of its growth. Obviously, if you have inflation that is rising, the Fed is going to look at this and say, hey, we want to cut back, turn down the faucet. We want to cut back on the money supply because we're worried about inflation. There are times where recession kind of takes the lead, and that's not as important. So we see here, inflation wasn't as of concern in the early 90s when we were trying to grow the economy out of recession. And so the money supply grew a little faster than inflation, and then it peaked, but then again we started to cut back on that money supply as we were concerned about inflationary pressures. And this led to this idea of an inflation tax. It's essentially reducing the value of money held by the public because of inflation, simply put. Think of the money supply that's out there, and the inflation rate is essentially how much less is my money worth today than it was yesterday on the money that I'm holding, okay? We talked about before the idea that putting your money under the mattress is not a wise decision, because the money that you put under the mattress is going to continually be worth less. You want to put it in investments that are going to make you money, make you profitable. And put your money to work for you. Not safety is not the concern. The concern is less about safety and more about growth. And so the inflation tax is really a concern because you're holding on to the cash. What are you not doing with it, especially as the money continues to diminish in value as inflation rises? And that's the real inflation tax. The rate times the money supply is essentially the real inflation tax that we see here. Now, again, I mentioned it, hyperinflation. We've seen extremes of this hyperinflation throughout history, and usually it leads to political upheaval. We look at Germany, for instance, in the 1920s. Their currency so worthless that kids are using it to play with. You have some families that are using it to burn in their stoves in order to keep warm. They're using it for heat. Because it is so worthless, and that obviously is going to lead to changes in political leadership in governments in terms of that. We see kids making kites out of it because it's so worthless in that respect. Hyperinflation is nobody's friend, and what causes it? Again, when you print too much money, and too much money is out there and you're not tightening the money supply. The idea of tightening the money supply, again, using the bird strategy, bonds, buying bonds to grow the economy, selling bonds to slow the economy down, interest rates, raise them to slow the economy down, lower them in order to grow the economy. And the same thing with the reserve requirements. Lower those reserve requirements to grow the economy, raise them to slow the economy down. And the discount rate, same thing, right? Lower the rate to grow the economy, raise the rate to slow the economy down. But hyperinflation is caused because there's too much money out there chasing too few goods, okay? The idea is inflation is when, and hyperinflation is when we have so much money out there, there's so much money out there that people are irrationally exuberant with it. They decide that they're going to pay exorbitant sums of money for goods that are being priced way beyond what they are worth, and that is inflationary. Okay, and hyperinflation is when people do that without even batting an eye because they look at it and go, I want it, it's so worth it. And there are only so many of those resources out there, so the prices continue to rise. Until the government tightens the money supply, that hyperinflation continues. Until they use the bird strategy in order to tighten the money supply, that will continue to happen. So it is only when they raise interest rates, sell bonds, raise reserve requirements, and or raise the discount rate that they can get inflation back under control. So what happens in terms of inflation and who does it benefit? Well, great question. If there is unanticipated inflation and as a result of this, inflation rises, this is going to benefit borrowers. This is going to benefit people that locked in on a loan. Now, lenders, banks, would actually be hurt by this in terms of if there's more inflationary pressure. Because the borrower is locked in on the loan. They're paying a fixed amount, or even an adjustable is still locked in for a certain period of time before it would rise. So it's still going to benefit borrowers, at least in the short term, until that rate changes. Now, if inflation, if we see deflation, the idea that the inflation is actually lower than we expected, this is going to benefit lenders, banks, because borrowers already locked in on those loans. They've already they've already received their set interest rate, and if inflation is lower than that, it's gonna benefit the lender because the borrowers are already paying that particular fee, whether it's adjustable in the short term or whether it is fixed rate. It is going to benefit the lender and hurt the borrower, and that really is the difference there. So if the inflation is higher than expected, it's going to benefit borrowers. If it is lower than expected, it would hurt borrowers. If inflation is higher than expected, it's going to hurt lenders. But if it's lower than expected, it would help lenders. It would definitely benefit them. And so what are the effects of this inflation? This leads to a concept we call the Fisher effect, which is if we have the expectation, and you notice back there I said we anticipate inflation to be a certain amount. And we're usually looking at this as 2.5%, if you will. Around 2.5% is usually is what the Fed is looking at right now in terms of an anticipated inflation rate. We're anticipating it to be 2.5%. So if it's more than that or less than that, that's going to have an impact on how people view inflation, either starting to get out of control, or we've got way under deflationary pressures. So the Fisher effect says if we can expect inflation and we have anticipated inflation and it rises by the level that we anticipate or expect, then there's really no change. There's really no change in the real interest rate. Because what we're looking at here is the inflation we anticipated. Where we get into trouble is when we don't anticipate an inflation rise, and we say it's going to rise 10%, as you see here, and maybe it rises 20%. Then that's going to raise a lot of red flags. That's going to cause a lot of concern. But the idea is, if it is baked in, if it is anticipated or expected, then it's not going to be really a surprise to anyone in terms of that inflation rate. And so the real interest rate is going to be unchanged. It's going to be no different. Now, some costs that we see of inflation. This is kind of old school, but costs of inflation that your textbook mentions are shoe leather costs. How much does it cost in shoe leather to basically run to the bank to get money out of the bank in order to pay for transactions that you normally would pay for in an average day? I guess we could look at that more in terms of gas costs today. How much does it cost us in gas to keep running back to the bank to get additional money in order to pay for these things? And again, even that is somewhat dated, because now we can use debit cards and we can use Apple Pay and other resources to pay for these that we don't necessarily have to use shoe leather or gas to do. Menu costs, the idea of changing prices, the costs of these changing prices. Changing prices on the menu is going to cost you in terms of how much it costs to print a new menu every time the prices are changing. This could be inflationary. And then unit of account costs, this idea that money is not necessarily a reliable measure of the value of currency that's out there. People are using actual goods instead. And what we saw in Germany was that the currency was no longer valuable. People were trading eggs and coal, pieces of coal, because that was a better unit of account than money itself. It wasn't easily transportable and being able to be carried around. So unit of account is important because when people cease to rely on your currency as value. Remember, our currency is fiat money. It's basically backed by the full faith and credit of the United States government, but there's no gold, there's no silver, there's nothing backing it up. And so unit of account, when that comes to fruition, you're in trouble because your currency is essentially worthless. So you definitely have to be careful and wary of inflation there and concerns about inflation. And likewise, you have to be concerned about deflation, the idea of prices going lower, because then people lose jobs. You get in the opposite problem, which is people lose work. They're hired, but at lower costs. It costs them less to buy things, but the net is they're not making as much money either. So what did you really gain from that? Well, really nothing, and actually it's worse because you're in recession at that point. So you definitely don't want to have too much deflation there either. We'll talk about that in a second. The inflation and the nominal interest rate, as you can see, the nominal rate kind of following or trying to as closely mirror the inflation rate as possible when needed. When inflation is high, we saw this in the 70s and 80s. When inflation is high, you can see the Fed will raise rates, and they will do this to try and keep inflation at bay. Now, in the 70s, they weren't so successful in making that happen and trying to keep that under control. You can see the peak there in the late 70s, early 80s. That was a real tough one because you had a supply shock that was also happening at that time. So context is important here too. But think of the 90s, in which inflation was of concern during the tech boom, but you saw the Fed raising rates at a lot higher clip than inflation rates were rising. And the reason they were able to keep inflation low was because they raised those rates and were pretty active in raising those rates to keep inflation at bay. And they were successful in doing so for the most part. They were successful in being able to stanch the bleeding on concerns of inflation. So now let's talk about deflation. This is the idea that we have unexpected downturns in prices. The idea is that aggregate demand leads to prices that are lower than what we saw before. The opposite of inflation, the idea that prices are falling. But remember, this is usually accompanied by other problems. So while the price of gas is lower, while the price of bread and milk and cheese is lower, you also have Sticky wages that are sticky, but ultimately are going to be lower. Maybe people are losing their jobs. Maybe they're getting cut back in hours. Maybe they are having to take the same job at reduced pay. And these are all signs of deflation. And deflation is usually accompanied by some type of recession, some type of economic downturn that is a result of these deflationary pressures that are taking shape. So what happens here? Well, the Fed tries to step in and lower rates in order to encourage more growth and get inflation, get deflation turned around and get it to be more inflationary than deflationary. But there's only so many places you can go. And so if your rates are already low, that's a problem. That's what we call the zero bound. If you're already there, this is a real problem. And this is what Japan got into in the 90s. Their rates were already low, and then they experienced recession, and then they ended up in what's called a liquidity trap. They lowered rates to a point that were so low, and then recession hit. And then where could they go? You had no other option but to spend a lot of money, aggregate demand, the government spending to boost aggregate demand, and then hope and pray that it moved quickly to try and get us out of recession. As you can see here, it did not. It took them quite a while to get out of that, and time. Time is key, and a lot of spending. They spent billions of dollars in trying to right this wrong of the zero bound. So this is the liquidity trap. When people don't want the money, they don't need it, and you're already at low rates, so where are you going to go? Well, you could lower the rate to negative numbers and basically pay people to take the money, but who wants to do that? And you have deflationary pressures because of recession. It really is a difficult model to try and get out of, and that is the liquidity trap that we learned from in the 1990s from Japan. Now, if you look at our zero bound in U.S. history, we can see that the recession of 2008-2009 really led to a zero bound historical aspect in terms of what we see here. We saw rates pretty low, and they didn't start to rise until well into 2015, late 2015, early 2016, when we started seeing rates going up again. You may remember that President Trump tweeted about this. He was not happy that the Fed was raising rates during his administration. He wanted, with the tax cuts that he and Congress had approved, he wanted them to lower rates to encourage more investment, encourage more growth in GDP. But the Fed was more worried about inflation than they were about unemployment. Unemployment was pretty low, and some of the lowest we've had in history. So the Fed wasn't worried about that. They were more worried about inflation, which is why they were raising rates, leading the president to lambast them on Twitter. But luckily, they did have rates up a little, so that there was some place they could go when the coronavirus hit, because they did lower rates, as you can see here, very quickly once the coronavirus took shape and we started to see this COVID recession that we're in now. And had they not raised rates back then, they would have been in even dire straits in terms of how much money they would have had to spend. I mean, we spent enough already, right? You're thinking. But you would have had to spend even more money in order to get out of this of this recessionary quality. And right now we see they've lowered rates as low as they can go. The federal funds rate is 0.25%, essentially the lowest that we traditionally see the Fed lowering rates. And so how long we will be in that zero bound remains to be seen. But the Fed and Congress and the President have been putting a lot of government spending towards growing the economy and shifting AD rightward. We will to be continued. We will see how history tells the story. So how do we measure inflation then? Let's take a turn here looking at measuring inflation. You may remember CPI from government class, the idea of measuring inflation rates using the Consumer Price Index. Well, we look at inflation rates through FRED, the Federal Reserve economic data that is out there. And we can see that there is some concerns about inflationary pressures with all the money that's out there in the spending during coronavirus, and the fact that people are starting to spend again after they basically kept their money at home for a year. Well, even 3 months after that, I think people started spending online, as we've seen some data to prove that earlier in the year. So we started to see some inflationary pressures here. It's still below 2.5%. The Fed doesn't seem to be worried. We talked about the 60 Minutes clip in class where the Fed chair, Jay Powell, talked about 2.5% is where we want to be, but we want to see it average 2.5% over a longer period of time than just like right now. And so that is leading them to kind of stay put where they are right now, but they are buying a lot of corporate debt. They are continuing to buy bonds to grow the economy and continuing to spend on corporate debt and other assets to keep the economy moving and to try and promote growth. And really, their focus more is on unemployment. The 8.5 million people that are still unemployed. We'll see what those numbers look like later this week. But so far, they have been pretty impressive in terms of trying to get people back to work, which is very fortunate of us to be able to have that capacity. So inflation, a concern, but not a great concern, and certainly not as great as unemployment right now in terms of what the Fed is focused on. We can see the inflation rate here, 5-year, 10-year, whatever the case may be in terms of the expectations. But the idea is the Fed isn't really concerned about this. The question is, how do we measure this inflation? How do they get to these numbers? Well, think of going to the grocery store. You're going over here to Giant at G Square, and you put items in a shopping cart that you're buying, and then you go to the checkout at the register, and then you get your receipt and you see how much it cost you to buy these items. Well, next month you go in there and you buy the same items again. You put the same items in the cart, and then you tally it up again and you see how much it cost you, and you compare it to what you bought last month and the month before and the year before. And this is the data that the Fed uses to determine the Consumer Price Index, or CPI. So to measure inflation, we look at the consumer prices. Consumer Price Index is essentially looking at products like bananas. And this chart goes back 20 years. The Bureau of Labor Statistics gathers all this data, and every month they price how much bananas are. Each month they add to this data. So right now, 59 cents a pound. The bananas I just bought are 59 cents a pound. And you can see 20 years ago they were about 52 cents. 2001 they were about 50 cents, 49.6. So there is a little bit of pricing increase there, but nothing significant over 20 years, certainly. So not really a whole lot of inflationary pressure there. We look at eggs, the Consumer Price Index on eggs. 20 years ago, they were 94 cents. Today, they're $1.60. So that's some inflationary pressures, pricing pressures at work there in terms of what we've seen. But again, it's over 20 years, so no surprises there. We look at milk. Today, it's about $3.37. We can see 20 years ago, that was at about $2.85. There are subsidies involved in this, but again, pricing pressures with inflation and whatnot, nothing really outstanding here in terms of anything out of the ordinary. Now, we did see back in 2008, before the recession, that it almost went. It was in July. It was $3.96. It went almost to $4 a gallon for the milk. But we have not been back to those types of numbers since 2008 in terms of those pricing pressures. And then we look at gas, probably the most common one that is out there. You can see 20 years ago it was $1.48. Today it's $2.50 in terms of average prices. And this is how the Fed tackles all of the items in the cart, if you will, and measures inflation. They look at this in aggregate, so they look at this over time. They look at this each month, and then they compare month to month, year to year, decade to decade, to see what inflationary pressures have we had and what are we projecting, what is anticipated. Remember the Fisher effect. How do we anticipate the growth of inflation? Jay Powell talked about inflationary pressures being around 2.5%. So if they are 2.5%, we're not going to be surprised by that. And that's why these numbers aren't really surprising to anyone either. If we're seeing inflation growing at the expectation, then there's no real surprise that those inflationary pressures are there. If it goes above or below that significantly, that's when we would start to hear and see more concerns in the economy about consumer confidence, about aggregate demand, about purchasing power, and even what businesses are spending in those spaces. Now, Stuckflation, the idea of stagflation, we talked about this before, the idea of inflation but stagnant wages. Remember, wages are sticky in the short run, and so when you have stagflation, you have stagnant wages, you have high inflation, and that is not a good combination for workers. The cost of living continues to rise. Meanwhile, you're not making any more money than you were before. And with those cost increases, are we looking at recession? Are we looking at concerns about this stagflation we're talking about here. Is somebody going to potentially lose their job? That's dangerous in terms of the concerns about inflation that you see there as well. The last category we want to get to is what we call disinflation, and this is the idea that we are coming down from the inflationary pressures that we had. Okay, so inflation in the United States peaked in the early 1980s at 13%. We saw the graph earlier that addressed this idea of this peaking of inflation at 13%. And that's the highest we've really ever seen it at that 13% rate. Britain's was 26% in those 70s, in the 1970s. And again, there was a lot of other things going on. I mean, you think about the supply shortage, the supply shock that was actually taking place because of oil and technological missteps and that kind of thing. So when you have a booming economy, you're worried about inflation. When you have and are concerned about inflation, you try and engage in disinflation, the idea of bringing those costs back down from where they were. And so this is where you go to the right side of this fiscal policy equation to raise taxes and cut government spending. Well, nobody likes to do those things, as we know. So then we're relying on the Fed. We're relying on the Fed to sell bonds, to raise interest rates, to raise reserve requirements, to raise the discount rate on banks borrowing money to meet their reserve requirements. They're doing these things to bring down inflation. And that's what we saw the Fed doing in the 1990s, going back to that model that we looked at before. Why is it that we didn't see a lot of inflationary pressure here, or more inflationary pressure here? Because the Fed moved swiftly to raise those rates. And they saw that the need to raise those rates. They did it quickly. They tempered when they were concerned, and then they raised them again. Again, concerns about inflation. They saw inflation starting to rise. They raised the rates. So this is where the Fed really does take a more proactive role, and it's an important one because it is keeping us from recession by engaging in that disinflation that we see. And that is so important to keep us from repeating the inflationary worries of the 1970s. There are a couple of summaries here for you to take a look at, and I encourage you to pause the video and read through those. There are also some key terms from this chapter, things that we mentioned here in terms of the inflation tax, the long-run Phillips curve, the zero bound, and the liquidity trap. Again, there are explainers on crowding out effect if you need a second opinion, as well as explainers on inflation. And then if you want to take a look at this 60 Minutes clip from the chair of the Fed, Jay Powell, talking about that 2.5% expectation rate. Again, think Fisher effect. The expectation rate of 2.5%. There's a link to it here in these slides. Here are the answers to the take-home quiz study questions for Chapter 16, Chapter 33 in the book. So you can pause the video and check those out. Also, the answers with explanations have been posted to the MyMCPS Classroom modules section for this chapter, for Chapter 16. So do check those out as well. And then I've also included answers to the sample questions for this unit, which covers all three chapters, 14, 15, and 16, that I think you'll find helpful. This concludes the overview on inflation, disinflation, and deflation, the overview of Chapter 16 in the online text, Chapter 33 in the book. I hope you found this helpful. We will be back in the next video and in the next unit looking at long-run economic growth. I hope you'll join me.